Hey, welcome back. Steve Peterson with Infinity Investments, and welcome to our channel where we talk all things commercial and investment real estate. And today's video is particularly important because we're going to talk about the 3 ways how inflation is impacting commercial real estate. All right. And I'm also going to talk about how we as professionals in the business, whether you're a broker, your agent, investor, developer, how we can utilize this time to actually advance our business to move forward. All right. So number one way, and it's an obvious thing, right? So anytime there's in major inflationary periods of time, interest rates are going to go up, right? Duh. Okay, we're obviously in that period of time. If you look at the 70s, you saw interest rates in the 19-20%, right? They had the rate, they took, the dollar off the gold standard, that created, crazy inflation, right? And so extreme interest rates fall. Now, we have in this environment and maybe an extreme jump in interest rates. This time last year, I'm in September right now. I think you could have got an interest rate on an apartment building low 3% for sure. I know people getting high 2%. Right now, you're in the 5%, maybe low 4s if you're at a really good bank or you got a good profile. But you're probably looking in the 5% range, right? So that's over a doubling of the interest rate. But look, 5, call it 6%, still relatively low in the bigger scheme of things. However, it is an effect, okay? Our whole economy essentially operates on credit. So an inflated cost of credit is going to have an effect on the economy. Now, that being said, interest rates and cap rates typically in history have run consistent with cap rates being just a little bit higher than the going interest rates of mortgage, right? As investors, we always want to make sure we get a property that has a cap rate that's higher than the interest rate of our existing debt, right? So typically cap rates are going to run higher than interest rates. And so that should have an effect on values. We're just now starting to see, I'm in the Bay Area, we're just now starting to see higher cap rates, but the cap rates have not jumped nearly as high as the interest rates. So that's very interesting, and that's one thing to watch though, because as we see even more interest rate, hikes, I just gotta believe at some point we're gonna see more and more, cap rate movement. However, we haven't seen it as much as of right now. So that's an interesting thing. So one thing I want us all to watch and be aware of is what cap rates are doing in our respective markets, because that directly affects the values, right? And we are seeing values leveling off, if not dropping a little bit for sure here in the Bay Area. And I think you guys are probably seeing that across the country as well, all right? And everything I'm gonna tell you as a point that affects the marketplace, I'm going to tell you some things I think we can do to advance our business during this time as well. Because money is out there, right? It's higher, it's more expensive. Lenders are a little bit more cautious, but a lot of money's out there. However, it is slowing down deal flow. And doing some research, knowing some investors from this period of time in the 70s, when these interest rates were crazy, that's when a lot of wheeling and dealing was going on in the world of creative financing. In the world of lease with options to buy, wraparound mortgages, seller carry first and second deeds of trust, right? It's where the sellers can say, hey, look, my property's not, selling. What can I do? It's mainly because of these interest rates and financing. Well, I have equity as a seller. Can I get creative and then carry some of that financing and make the property more attractive? And that's certainly one thing I think. I don't care if you're a developer, investor, brokers, agent. If we learn how to work creative finance deals to where they make the most sense, then we are going to position ourselves to be able to actually benefit well during this period of time. All right. Another sidebar to that is formal assumptions. What I mean by formal assumptions, say somebody has a Fannie Mae, Freddie Mac, FHA loan, or just a portfolio commercial loan where they will allow, that loan has a clause that will allow someone to assume the mortgage. Now, in the last few years, all these mortgages have been done, especially 2021. Imagine 2021, I think, this is not an official stat. This is me, having my feet to the street. I think was the #1 deal making year in commercial real estate. That's just me knowing people, being in the industry, getting everyone's emails about how many deals they close and how much volume they close. I think last year was probably the biggest year of commercial real estate, right? So what that means, there was a lot of 2% money, 3% money that was originated, right? A lot of those, especially in the multifamily space, they're going to have, 3 to 5 year yield maintenance defeasance, which is basically a complicated word for a hefty prepayment penalty, right? So even if they did sell those properties and when someone was able to get new financing, they're going to pay for it. However, a lot of those loans have assumption clauses to where someone can pay, I think 1%, maybe 2%, depending, and come and assume that 2 to 3% mortgage. And that, finding somebody that's selling a property where you can assume they got a low interest rate, now you've beat the street and now you've advanced your business during this crazy time, right? Very important. Second way inflation is impacting commercial real estate is in operating costs. The cost of doing business, okay? The cost of your water bill, the cost of your gas and electric, the cost of maintenance supplies, it's all going up. And what does that eat away at? Your net operating income. In many cases, even in non-rent control markets, the expenses are growing at a faster rate than your income is, right? So that's the negative part about it. Another negative thing about that, right, is that when you're running an apartment building, you're running an office building. Now, if you're running a single tenant triple net, though, again, maybe it doesn't affect you as much, but it does affect your tenant. And if it affects your tenant, it does affect you in a way, all right? So this is the time to really be aware of your bottom line, to really manage your manager, if you have a property manager, to really make sure that you're being efficient as possible. And this is when, if you installed all the energy efficient, devices that you could, where it's actually benefiting you now, because costs are up extremely high. And if there's any way for you to pass that on to the tenant, and if you're able to do that without losing good tenants, then you want to be able to do that, right? The issue with that is that the tenant, the person, the consumer, they're getting everything passed along to them, right? If you've been in a grocery store, like I have recently, and you got that sticker shock, I bought some salmon. I did a video on this recently. I went to Whole Foods. I bought some salmon. It's $30-something. And I sat there and said, well, I literally could have went to a restaurant, sat down, got served, and got 16 ounces of salmon cheaper than what I just paid for in the store, right? So that's sticker shock. That's frustrating. So that same person, you got to be, as you're passing stuff along to the tenant, you just got to be aware that they're getting everything passed along to them, and they're probably making us flat a certain amount. So there comes a breaking point to where they can't, handle that. But you as an operator, you've got to figure out ways to pass these costs along, to minimize these costs, and to just figure out how to navigate your business during these times and negotiate where you can negotiate. A lot of people forget about things. A lot of times things aren't negotiable. Now, maybe your PG&E, gas and electric bill, is not negotiable. But maybe your maintenance service contract is, okay? Maybe your pest control contract is. Maybe maybe your landscaping contract is, all right? And so just a couple of ideas of how you can minimize these expenses, all right? Because they are coming, they are higher. We all have to deal with them, all right? The way you can, benefit from this, all right? Now, as you're going out there looking and acquiring properties, is to use this to your advantage when you're negotiating. Say, hey, look, I'm looking at your P&L right now. This is where the NOI is. But, we know we're going to have about a 10 to 15% increase in these numbers. So I'm discounting that now legitimately. And here's my price. A lot of times when we're negotiating, if we can justify where we're coming from, we can push forward our agenda. If we just shoot numbers from the hip, a lot of times that pisses the other person off. But if we can legitimately say, well, this is how we came up with our number, anyone else is going to have to deal with this. Now, this is a way that we can move forward and push this deal forward. You have a better chance of making a deal, and a really good deal at that one. So that's how you can use this. The second thing that is how inflation is affecting the commercial real estate industry to advance your business. All right. And the third thing about how inflation is affecting us is in the rental market. The positive thing about inflation for, not for tenants, but for landlords, for brokers, agents, investors, developers, is that we're seeing a pretty aggressive increase in rents. All right, and a big part of that is because now homeowners who only a year ago were looking at 2.5% interest rates are now looking at 5.5% to 6% interest rates, right? And so a lot of them are priced out of home ownership right now, unfortunately. But they got to live somewhere. They got to move here, move there. There's a lot of migration going on, a lot of people moving from state to state, a lot of people moving from city to city, neighborhood to neighborhood, all right? And rents are way up. In a way, that's a positive thing for us to be able to go and achieve higher rents. If you're in a rent control property, you're not really able to benefit from that unless you have something like Section 8 tenants, which in my area, Section 8 tenants are not subject to rent control. So that's how, if you got Section 8 tenants in a building, in an area where it's rent control, you can still benefit from that, all right? And or if you invest in an area where there's not rent control, now you can benefit from the rental market as units turn, as leases turn, right? And same thing with commercial real estate on retail properties and office properties. However, all right, because of the economic upheaval, there's less and less, business tenants out there trying to lease space. The flip side of that, though, and I just read an article on LinkedIn talking about that retail leasing has actually had its best quarter in a while. And I think what we're seeing because of all this is that we're seeing companies shifting their leasing strategy. Maybe they're going from bigger properties to smaller properties, all right? More strategically located properties, all right? And different kinds of footprints. So rents in general are going up. That does create some challenges in the economy. As a landlord, as a professional, you gotta find a way how you can make that work towards your advantage. And the obvious thing is just owning commercial real estate that has fixed interest rate debt, where you have your rents growth outpacing your expense growth, meaning you chose a wise building, is now a great way how you can advance and beat inflation during this time. So I hope this was helpful. If it is, throw me a like, subscribe, share this with friends. And we just have to keep being creative. This is the time for creativity. I think that's the biggest way how we beat inflation in our commercial real estate business, but also in our lives. Hope it was helpful. To the next video. Peace.